Here's a shocking fact that Wall Street doesn't want you to know. The average investor with an IQ of 160 performs worse in the stock market than someone with an IQ of 100. Nobel Prize winners, PhD economists, and brilliant mathematicians consistently underperform simple index funds. Meanwhile, a folksy guy from Omaha, Nebraska, became one of the richest people in the world using principles his mentor taught him in the 1950s. Hey everyone! Welcome back to KP Money Talks, where we simplify personal finance in Canada, and today we are going to reveal why intelligence can actually hurt your investment returns, the psychological traps that destroy even the smartest portfolios, and exactly how Warren Buffett and Benjamin Graham built a system that turns emotions from your enemy into your advantage. If you've ever bought high and sold low, chased the latest hot stock, or lost sleep over your portfolio, this video will fundamentally change how you think about investing. Get ready for some uncomfortable truths about your brain and your money.
Before we dive in, let me ask you something. Have you ever made a really smart analysis about a stock, felt confident about your research, and then watched helplessly as you made the exact opposite decision when it came time to actually invest? You're not alone. Studies show that the average investor earns about 2.9% annually, while the S&P 500 returns about 10%. That's not because people are stupid. It's because our brains are wired for survival in the African savanna 50,000 years ago, not for navigating modern financial markets. I've spent over a decade studying behavioral finance, and I've seen brilliant doctors, engineers, and executives make the same predictable mistakes over and over again. But I've also seen ordinary people build extraordinary wealth by understanding and working with their psychology instead of against it.
Today we're going to explore the fascinating intersection of psychology and investing, using the timeless wisdom of Benjamin Graham and Warren Buffett as our guide. These two men understood something profound. The stock market isn't just about numbers and analysis. It's about human nature. And once you understand human nature, including your own, you can turn what destroys most investors into your greatest advantage. Let's start with an uncomfortable truth. Intelligence can be a liability in investing. Here's why. The very first is overconfidence trap. Highly intelligent people are used to being right. They've excelled in school, succeeded in their careers, and solved complex problems. This creates what psychologists call overconfidence bias. When smart people research investments, they find data that supports their thesis and dismiss contradictory information. They think, I'm smart, I've done my research, therefore I must be right. But the market doesn't care about your IQ or your Harvard MBA. Warren Buffett once said that success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. The second is complexity addiction. Intelligent investors often fall into what I call complexity addiction. They create elaborate models, use sophisticated formulas, and develop intricate trading strategies. But complexity is often the enemy of returns, whereas Benjamin Graham, Buffett's mentor, had a simple approach. Buy undervalued companies and wait. No complex algorithms, no derivatives, no market timing. Just patience and discipline. Think about it. The most successful investment strategy of all time can be explained to a child. Buy good businesses when they're trading below their intrinsic value. Hold them until they're not. Repeat. The third is analysis paralysis effect. Smart people also suffer from analysis paralysis. They research endlessly, looking for the perfect investment, the ideal entry point, the optimal allocation. Meanwhile, they miss obvious opportunities because they're stuck in research mode. I know investors who have been researching the same stock for 2 years and still haven't bought a single share. Perfect is the enemy of good, especially in investing. The fourth is academic trap. Many highly educated investors believe markets are efficient, that all information is already priced in. This leads to passive acceptance of market prices rather than looking for the mispriced opportunities that create wealth. But if markets were truly efficient, Warren Buffett wouldn't exist. Benjamin Graham wouldn't have consistently found undervalued securities. The fact that some investors consistently outperform proves that markets are not perfectly efficient. Finally is short-term thinking bias. Intelligent people often have demanding careers that reward quick thinking and fast results. They bring this mindset to investing, expecting immediate returns and getting frustrated with the patient approach that builds wealth. While Graham taught that the stock market is a voting machine in the short run, but a weighing machine in the long run. Smart investors often focus too much on the voting, short-term price movements, and not enough on the weighing, long-term business fundamentals. Remember this, the market is designed to transfer money from the impatient to the patient. Most investors fail not because they're not smart enough, but because they can't control their emotions. Build your system. Trust your process. Let time and discipline create your wealth, just like Warren Buffett did. If you found value in this video, smash that subscribe button, hit the like, and share this with someone who needs to hear it. Drop a comment below with the biggest emotional investing trap you've faced. Stay patient, stay disciplined, stay invested. This is KP Money Talks, and I'll see you in the next video.